Ladies and gentlemen, thank you for returning so promptly after coffee. I hope you enjoyed the conversation. We now move to our second panel session of the day, Building a Dynamic and Competitive Economy, which will very much, clearly from the title, build on a lot of what we spent the earlier part of the morning talking about and a lot of what we heard in the speeches both from Kemi Badenoch and Mel Stride, as well as the previous panel. So the panel will be looking at the steps needed to simplify and modernise regulatory supervision and the taxation system, specific reforms and their prioritisation to address competitiveness and the impact on investment and innovation, and identifying and unpacking the risks if the UK does not reset its tax and regulatory framework. We have a fantastic panel to discuss this, chaired by Roshni Prasad, the Director of Capital, Investment and Financial Services at the British Consulate in Toronto. She will be joined by Deputy Rhona Humphreys from the States of Guernsey, Darren Ketteringham, UK Leader of Industry for Financial Services and Partner at PwC, David Shone, Partner in the Financial Regulation Group at Slaughter and May, and Atul Sodhi, the Chief Executive Officer, UK at Credit Agricole. Could you please welcome them to the stage?
Good morning, everyone. Thank you so much for joining us after the break. As Miles said, my name is Roshni. I work for the British government, and I've been in this role for the British Consulate in Toronto for the last year, but I've been working on inward investment for the UK government for the last 7 years. The role that I have at the moment is with the Office for Investment, and I'm the representative for capital investment and financial services for the UK government in Canada. So what that means is I'm there to represent the UK's financial services sectors to investors in Canada, primarily private markets investors such as Canadian pension funds, and we sort of sit at that interface between industry and government to try and make the pitch for the UK. Everyone in this room knows the strengths of the city of London, but that is sometimes a harder sell abroad, so I'll bring some of those perspectives to this panel. I'm joined by an excellent panel today, and I'll just give them a quick moment to say who they are and what they do. Atul, starting with you first.
Thanks, Roshni. So, good morning, everyone. Atul Sodhi. I'm the CEO for Credit Agricole CIB in the UK. I've been in the UK for just under 2 years after a career in banking that has taken me to starting with India, then to Hong Kong, and then Paris, and then now here. And Credit Agricole's CIB is a large corporate and investment bank with a global presence, but with a strong presence in the UK.
Thanks very much. Good to see you all. I'm David Shone. I'm a partner in the Financial Regulation Group at Slaughter and May. As some of you may know, we're an international law firm supporting businesses in the UK and elsewhere, and particularly working within the city with a number of regulated financial institutions.
Hi, good morning, everybody. I'm Darren Ketteringham. I lead our financial services business for PwC here in the UK, and look, I'd like to say a big thanks to Miles and the City UK for their terrific partnership in writing the No Time to Lose report, which I know we'll be touching on, and we have done, and we'll touch on throughout the day. So thanks once again, Miles and the City UK.
Hello, I'm Deputy Rhona Humphreys, a member of the Government of Guernsey. I sit on the Government's Economic Development Committee, and prior to that have a 30-year career in financial services in the island.
Excellent. Thank you all so much for joining us. Now, the panel today, we're going to be talking about what we need to do to reset the UK's tax and regulatory framework. Obviously, we've just heard from the Leader of the Opposition about what they would do should they come into power. And we've had a lot of discussion throughout the day on what proportionate regulation means and how we can ensure that we strike the right balance. It's a very interesting climate at the moment. Geopolitical competition has never been higher. There's a lot of discussion about whether there's an AI bubble that's approaching, and I think it's more important than ever to think about the pragmatism that we take whilst avoiding leaning towards over-regulation. So, Darren, to set the scene, we've talked about the City UK and PwC's No Time to Lose report, which has been described as one of the biggest listening exercises with the financial and related professional services industry and its stakeholders. Now, I'm sure everyone in the room has read it cover to cover, but for anyone who needs a refresher, please could you tell us what the key messages were in relation to resetting regulation and tax for the future of finance? And could you offer a bit of a flavour of how the government and regulators have responded to the report so far?
Yeah, sure. Look, and as Anne mentioned in her keynote address, we interviewed 300 senior industry leaders, and the top two priorities that they all came up with. Number one was in the panel before, which was about leading in financial technology. But the second one that was top of mind for all of those industry leaders was really about resetting tax and regulation for the future of finance. And if I take those in turn, the report, we summarised tax into sort of 4 key areas. Firstly, we need to restore tax predictability and bring more certainty, reassurance and confidence with a longer-term roadmap for tax and for those taxes particularly that are most important for financial services. And secondly, we must maintain international competitiveness. That's critically important. We've got to continue to review sector taxes and those taxes that influence the flow of capital and talent into the UK. Thirdly, we've got to simplify the whole tax code. It costs far too much to comply with. It's very duplicative and lots of overlapping requirements. And fourthly, I'd argue that the tax authorities need to work closer with the regulators, actually, and align on those levers that tax authorities can pull to better influence and stimulate growth and competition. Examples are like tokenisation, working closer together. There are also big tax consequences of tokenisation, and more get up to speed on from the tax perspective on things like captive insurance, where the regulators have moved ahead on. So those are the sort of 4 key areas, really, from a tax perspective. And look, when we talk to HMRC and HMT, you know, they were very positive about the report. In fact, they agreed with all the recommendations. I think the trick now is, with all the pressures politically and fiscally, is how do they take some of these actions forward and deliver on some of those recommendations. If I turn to regulation, there were sort of 5 key points that we summarised here. Firstly, we've got to streamline and simplify regulation. And a recent report that we did again with City UK on the cost of compliance, we estimated it cost the FS industry £34 billion a year to comply with regulation. That's a staggering number, and that equates to about 13% of annual operating costs for financial services companies. That's far too much, and we must reduce that. Secondly, we need faster regulatory processes. I think when you talk to CEOs and chairs of our FS companies, they'd all say, look, in order to drive activity to the UK, we've got to be the easiest place to set up business, grow your business and operate. And we're not at the moment. And part of that is because we have suboptimal regulatory processes. It cannot be that it takes years to get authorised in this country as a business. It cannot be that it takes years to get your models approved. So we've really got to address that. Thirdly, we need greater, I think, proportionality when it comes to retail and wholesale regulation. I think we need to redefine those barriers and make that more distinguished to make sure that we're not bleeding one into the other. I think fourthly, and I think Mel Stride and Kemi touched upon this, we need to recalibrate prudential requirements. We've got to move on from 2008 where the prudential requirements were absolutely right at that period of time, but we need to free up capital, liquidity, take away those overlays and those add-ons to be able to invest and flow more capital into the UK economy. Then we've got to, lastly, think about how we give the regulators more political air cover. And I think that, again, that's been mentioned this morning, that, in order for the regulators to deliver on their secondary objectives of competitiveness and growth, we really need some air cover. We don't need them hauled before committees and doing please explains. We've got to accept that if we want more risk in the system, there's going to be some more failures and consumer harm, but we've got to be able to live with that and accept that and give those regulators some air cover. And again, when you talk to, whether it's Nikhil or Ashley at the FCA or Sam at the PRA are involved in the exercise here, they were very supportive. Again, both organisations endorsed the report, which is really positive. And I reflect sometimes, and I was talking to Miles about this, is that my 30 years in financial services, I probably haven't seen more alignment between industry, regulators, and government there is today. And I think we're a really positive platform to move forward, but we've got to do it with more ambition, more urgency, and better execution, as I think Anne and Miles set out at the start.
Darren, thank you so much. I think there's a lot of themes that we're going to be coming back to there. First, I'm going to come to you, David, in terms of the regulation aspects of the report. So the report calls for streamlining the rulebook, focusing more on principles and outcomes, and, as Darren mentioned, removing duplication. Concretely for you, what are the key changes, whether it's in the rules themselves or the UK's supervisory approach, that would make the biggest measurable difference when it comes to firms' compliance burdens?
I think there are two things to consider here, and I'm afraid I'm going to be in violent agreement with Darren on this. There's the compliance burden point, and there's the what can we do to promote growth. And I think actually they're two sort of subtly different things. But if we take the compliance burden, I think there are three aspects of that I would focus on. The first is process points. So, what from a day-to-day perspective can you do to make regulation work better for financial institutions and indeed the regulators who are currently required to sift through huge amounts of data that they collect and frankly can't do much with in some cases. So I think that's something that we need to look at. We need to look at the processes themselves. So where, for example, it's taking years rather than months to get authorised, to get models approved, as you were saying, Darren, clearly that needs to be looked at so that there can be a more targeted, more risk-sensitive approach to some of those processes. And then actually we need to look at some of the reporting requirements, for example, that still apply as a result of legacy EU regimes and ensure that there's no duplication there so that the day-to-day burden on firms is really reduced. I think the second point is on the prudential side. I sort of have a slight nervousness about using prudential measures to promote macroeconomic objectives. But having said that, it's clear that the hodgepodge of regimes that we've ended up with isn't quite calibrated in the right way. And we do have a fantastic opportunity in the form of the implementation of Basel 3.1 over the next few years to actually address that. And that can be addressed not by means of primary legislation necessarily, but through the soft supervisory measures that accompany it. So looking at some sort of targeted reforms to the leverage ratio regime, for example, to ensure that it is operating properly and that it's serving as a backstop rather than a binding ratio where it's appropriate to do that. And then actually at the middle of the market, so looking at mid-tier banks and the range of overlapping regimes that apply to those institutions, and I think really serves to stifle growth within that particular bit of the sector. We heard Kemi talk about the ring-fencing regime and ask, I think rightly, whether that is really necessary given the developments that there's been in resolution policy and in other aspects of the regulatory framework over the past few years. I think that would be a good place to start, but we also need to look at MREL and the very significant capital burden that we put on some of those banks and whether it's appropriate to do that at all or whether it's appropriate to stagger it out over a more elongated period to ensure that they can actually reach target ratios within a way that is going to allow them to grow organically without punitive capital charges. The third thing I talk about, and I suspect this will be a theme across a number of the remarks today, is culture. And actually that really does need to be changed. I think it's right that the regulators have been given more rule-making powers, but I think we have to be realistic about what we can ask them to do. A lot of the powers that have now passed to the PRA and the FCA previously sat with the European Commission, which of course is more than just an administrative body, it is a policy-making political body as well. And I think politicians in particular need to be honest about where the boundaries of politics end and the boundaries of regulation begin. And I completely agree with what you were saying, Darren, about the need for political air cover, that there does need to be some acceptance that if we are going to reform the regime and introduce greater risk, that's something that politicians as well as regulators will need to live with. We can come on and talk about some of the sort of growth measures in particular, but I think that would be a good place to start.
Yeah, excellent. And just a reminder to the audience that the Q&A is open and we'll come to the Q&A questions in a little bit, so do keep submitting your questions through. Should we just go back to that political air cover point in a little bit more detail, and Rhona and Atul, if you want to come in on any of this as well, then please do. I think I'd be interested in whether there's any examples you've seen of perhaps something being attributed to the regulators where in fact it should have been politicians taking more of the stance with that, or where do you think What do you think good would look like if we're moving into a system where we are providing a bit more of that political air cover?
I think it's possible. If you look at some of the mass redress exercises, for example, that banks have had to carry out over the past few years, and the very difficult job, frankly, that the FCA has of navigating things like the current motor finance issue in a way that satisfies political demands and the demands of the media as well, but without imposing an undue burden on industry. Now, I happen to think that the FCA hasn't quite got that right on that occasion, and I'm sure there are lots of people in this room who will agree with that. Mm-hmm. But I think there has to be some acceptance on the part of politicians that if you give rule-making powers to regulators, then you have to allow them to get on with it and try not to give them too much grief if things perhaps don't go quite as expected.
Yes, yeah, a necessary measured risk in order to get to the kind of outcomes we'd like. Yeah. Atul, I'll come to you now. So Credit Agricole has been in the UK for over 150 years, but your career has taken you across the world. And I think we're interested, from the standpoint of a global bank, what some of the key conditions are that need to be in place to be conducive to making investment decisions. The leader of the opposition talked about wanting to create the conditions rather than over-regulating. So what do you think those conditions might be to lead to more capital deployment in the UK, or at the kind of global level, how you decide where new projects or functions might be located?
Yeah, sure. So a lot of what was covered by Darren and David is really an important part of what we need in terms of making sure that it is a great place to do business. But I'd also look at it from a glass half full point of view, and also from a perspective where partly we are here to support the businesses that our clients are doing. And to some extent, obviously, then we need capital on our own side to support that business. So if you look at it from what our clients are doing and the conversations we're having with our clients, while, of course, there is a lot that the UK needs to do, we also need to appreciate that the UK has a lot going for it as it is. The reality is the UK is still seen as a place which has a very strong, reliable legal system, an overall ecosystem, be it the law firms, the accounting firms, the consultants, the availability of talent, which is all needed for businesses to invest in a country. I'm not saying everything is perfect, but what I'm saying is there are a lot of countries in the world that would give an arm and a leg to have this kind of fundamental foundation that is strong, that can be built upon for more growth in the future. Indeed, we are living in a more complicated world. We're living in a geopolitically divided world. We're living with all that. But we must also recognize the strengths we have. So I think that's a very strong foundation that we have in the UK, but with more to do in the future. So when we talk to our clients, be it the private equity firms which are present worldwide and have very strong presence here, we talk to the asset managers, the hedge funds, the other banks, or the large corporates, be it American, be it European, be it Asian. For them, London is very much the capital of financial markets, leaving aside New York to some extent. But also London has a lot of inherent strengths in the fact that it's time zone-wise much more convenient for global firms to operate than for Asian firms that need to operate in the US markets. So the UK and London has a lot going for it on that, and that helps us, of course, in continuing to support our clients through that. And I can take a few examples. If you look at offshore wind, the UK is the largest center for offshore wind in the world, outside China, of course. But this has drawn in capital from all parts of the world, be it private equity, be it sovereign wealth funds from the Middle East, be it investors from Asia, be it European firms from different parts of Europe. And this is a recognition of the fact that when we get the ecosystem right, and the legal system, the contractual system, the supply chain right, the UK can be a center of excellence for what we get after. So from that point of view, I would say our clients are looking at the UK with a positive frame of mind, and as a result, we as an institution also, like you said, we've been here for 150 years, and we continue to grow, invest, put more capital at work in this market, partly to support, of course, what we do in the UK, but also out of the UK, we support global clients, be it Asian, be it American, be it European, be it Middle Eastern, and that's what keeps us going. And I have, while I completely agree with what my other panelists have said, that there is a lot more progress we can make, there's a lot of improvement we can do. We should also continue to appreciate and propagate the positive attributes that we have in the UK.
Absolutely. I think that's a really important anchor to this conversation because the UK does have those strong fundamentals, and I think, you know, at these sorts of in these sorts of forums, you'll hear a lot of comparison of different tax rates, and our headline tax rate not being as competitive, especially when you consider the different layering of taxes that firms are subject to. But, you know, the UK doesn't need to be part of a race to the bottom. We have those strong fundamentals. We don't need to be as aggressive as some of those other jurisdictions are when it comes to some of those fundamentals. Having said that, the report is explicit that tax has become overly complex and unpredictable, and that there's some simplification that can come there, and that the UK needs multi-year predictability. So, Deputy Rhona Humphreys, I'll come to you in terms of your perspective, including what you've seen in Guernsey. What do you think a credible predictability package looks like, and what must we include in order to shift sentiment?
I think it's interesting in that Guernsey is in a slightly different part of this curve, in that we have begun to move away from the difficulties of regulation, try and make it more pragmatic. And we've certainly got a regulator who does see growth as part of their agenda now, which is really useful. I think there are probably 7 key points that I can make around that. I think one of the things we try to do is provide clarity and predictability to the people working out of our island. We've got clear direction. We don't change the regulation very often. You know, and I think sometimes that simplification, not just of the tax system, but the supervision, is really important. And I think you can do that without reducing the confidence and stability. I think there has been concerns in the past that, you know, if you change it, you might break it and you might cause problems, but it doesn't have to be that. I think it can be far more than that. I guess as a small jurisdiction, this is easier for us, but, you know, speed is a competitive advantage to change quickly and to be nimble as things change. You know, it is a big beast. It is a ferry ship, a cruise ship, not a ferry boat, but, you know, you can change things. What's really important is the proximity and dialogue with industry. You need good IT systems, but you also need a human face behind that. I think one of Guernsey's key points is that they try to target 48 hours for anyone coming to the island to start business, to be able to have a conversation with the regulator, talk about what they want to do, talk about what they're trying to achieve. And I think that really has made a difference. You know, it is bring a coffee, you know, come and have a chat before you move too far down that route. And I think that really does promote economic development and helpfulness. As a jurisdiction, we are really willing to adapt to new markets and procedures. We try to build flexibility into our structures so that, you know, something that's used one way can be used a different way in the future if that's what the market demands. You know, we're seeing great trends in natural fuels, biodiversity, but also defence funds, right? And there's that whole discussion about what is a defence fund, when is a defence fund a good thing, when is it not a good thing. But we're really seeing movement in that area and people wanting to progress that through. And I think that's the sort of things that if you can adapt your system to embrace that, I think it is really important. It's not about not taking risk, it's about managing the risk you take at the end of the day. Implementation of regulation needs to be practical, it needs to work for industry, and the best way to deal with that is consultation up front and consultation throughout and being prepared to tweak and change. One good example we had, there's a product in Guernsey known as the Private Investment Fund, which was purely an investment product and you need to have an investment licence to run one. And then it came to light that actually, as families grow and wealth changes, the use of the family private investment fund, utilised by the fiduciary industry, not requiring an investment licence, was a real practical adaptation of a product we already had, and we've been able to do that and move that through. So that's been, those sort of things are really useful. You need a targeted approach to competitiveness, right? You need to look at all of your regulation through a competitive lens. You need to make sure that what you're doing doesn't take the edge off your competitiveness, even if it is mending something that might be broken. So it's about balancing those two things. A really difficult balance, but tweaks and adjustments will help that happen. And then finally, it's about international connectivity and equivalence. We need to be working alongside our competitors. We're a really small jurisdiction, but we're a member of the British family, and we are putting lots of investments into the UK. I don't think people understand the level. I mean, £58 billion last year into the UK economy, just by being a stable place where the investments can be made from. And I think, if the UK could work more actively with its British family, I think they really will see benefits from that. So ultimately, the key takeaway is it's not about lighter regulation, but it's about smarter and more responsive regulation. And I think you can get there through consultation, collaboration, and conversation with industry at the end of the day.
I think that's really great to link it back to the constituents of our British family and what we're all doing to support the city and the UK as a whole. I know Guernsey is, of course, a smaller jurisdiction, but how do you go about that consultation process in order to identify the tweaks that will happen?
I think there's the informal and the formal, right? I think the industry bodies meet with the regulator. That meeting happens once a quarter, but at the end of the day, there is an open door for that to be more often. And that's either done by a collective of all of our finance industries, but then each individual sector has their own opportunity to speak to the regulator. So that way round, that's about the industry bringing their issues to the regulator and just having a collaborative conversation. Additionally to that, there are formal consultation processes that are open through websites and things like that, and those get opened so that individuals or industry bodies or competitors themselves can respond. So it's just lots of different ways, but I think they work because the people taking part feel listened to, and they feel they're part of the process, and that those consultations are listened to and brought into the changes.
Absolutely, and I think that's where we in government find the convening power of the City UK to be enormously helpful. Absolutely. As well. And to our regulators' credit, I think we have seen the likes of the FCA and the PRA be very willing to speak directly to industry and take this kind of feedback on, which is really great to see as well. That's good. So I think this is more of a question for all the panelists, kind of bringing it back to the agenda as a whole. It's a big agenda. It covers legislation, regulation, supervision, tax compliance and tax rates, and pretty much the UK's overall fiscal approach. So with that in mind, how do you think we can encourage ambition and fundamental rather than incremental reform? And what do you think that this government should prioritise the delivery of in the next 12 months to match the scale and pace of the global competitive challenge? I suppose within that, I would also invite you to give any reflections on what we heard from the Leader of the Opposition earlier as well. Darren, would you like to go first?
Yeah, sure. So I think it's really important that we strategically look at those areas of focus that are going to maximise competition and stimulate growth. I think that's key, and I think one of the themes we've been running through today is that we need more ambition, we need more urgency and better execution, so apply that. Obviously, I'd like to think with the City UK that we've set out a roadmap in the report to sort of drive forward action and recommendations over the next 12 to 18 months timeframe. And it's really assuring that the industry is getting it together with the regulators and the government to sort of take these actions forward. One of the key areas for me, and we talked about it earlier in the panel, is leading the world on tokenisation. I think that's critically important. And why do I say that? Our financial services business is 80% international and 20% domestic. That's the inverse of somewhere like New York, which is 80% domestic, 20% international. We lead the world in fixed income, currency, commodities, specialty and finance. So we need to start there at fixed income, currency and commodities to make sure we're tokenizing those real world assets, because to protect and enhance our world leading position. And at the same time, obviously, we need to operate what we call this multi-moneyverse. So we need to have tokenized deposits, stable coins, central bank digital currencies coexisting together. I think all those three need to come together. And I think we just need to go further and faster. And I really welcome the appointment of Chris Willard. I think that's a great great appointment, and he's working really hard with industry and the regulators and government to really move this forward. But we've got to go further and faster than what we're doing at the moment, because we have to lead in that, and the consequences will be dreadful if we don't lead on that, because we'll have capital and liquidity erode away, as well as as well as talent as well. So we really must, sort of drive that really hard over the next 12 to 18 months.
I'd just add to that. I think when we look at our ecosystem here, clearly financial services is a very, very important part of it. And the City UK, of course, big thanks to them for getting this organized. But financial services, more than almost any other sector, is going to be impacted by the newer technologies. Be it AI, be it digital currencies, be it blockchain, and so on and so forth. So it is absolutely critical for us to keep leadership, to stay ahead of the curve on new technology. And that's what is going to drive investment by financial services firms, be it the traditional players or the new players in the sector. And one cannot emphasize that enough in terms of how not only regulators, of course regulators have a big role to play, but investors, banks, consultants, the accounting firms, everyone has a role to play in making sure that we stay ahead of that curve.
Yeah, I'd agree with all of that. I mean, I think if you're looking for a big bang type change, then clearly some targeted adjustments to the prudential regime could unleash significant amounts of capital and liquidity into the ecosystem, and I think that can only be a good thing. I think in terms of longer term growth, though, we need to do more and try better at encouraging innovation. And I think to the regulators' credit and to government's credit, there have been some really important steps in that direction. I think tokenisation is one important area of that. But I think also rolling out, as the report suggests, further sandboxes, be they formal or informal or just actually a feature of the way that the regulators regulate new businesses, so that if you've got exciting new businesses that want to come and build in London, want to make the most of the fantastic opportunities that there are here in terms of talent, time zones, engineering talent in particular, and build those businesses there, that we're creating an ecosystem that will continue to allow them to do it, and critically to do it in a way that means that when they get to scale, they look to stay here, list here, and actually help to support the broader UK ecosystem in that way, rather than just heading off over the pond.
Yeah, and I agree with all of that, and I'm bound to bring that back to utilising your British family, and particularly Guernsey, of course, but no, utilising your British family to help you with that, right? Because our speciality is in structuring finance and investment in such a way that it can be brought into the UK in a way that is financially viable and safe and secure. The other thing is we're small jurisdictions which can in themselves become sandboxes for this type of thing, right? They can actually be used in a very controlled environment to help and support this type of development. So just don't forget we're there, and we're there to support. Don't just beat us up.
Yeah, and I would love to, I totally agree with all of that. I would love to see the UK do even more in terms of sharing our digital innovation in the financial services industry across the world. Coming from my experience in Canada, they haven't yet achieved open banking in the Canadian system, and there's an awful lot that our international partners can learn from how we've approached that in the UK, which will create incredible growth for the financial services sector in these international markets and potential exports too. So we've got a few questions coming in, which is great, but I'm just going to do one more question for the panel before we go to that audience Q&A. This is the quick fire round, so 30-second answers, please. So we talked about some of the opportunities for the UK in resetting regulation and tax for the future of finance. And we've talked a little bit about the risks as well, but I think let's just boil it down in terms of what are the key risks facing the UK if we don't get this right. And what do you think the earliest warning sign is that we could look for? David, I'll come to you first on this one.
I mean, I think the risks are obvious. The UK financial services system is absolutely integral to and is a bellwether for the health of the broader British economy. So this is a whole of society, whole of economy risk, and the indicators I think are there in terms of who comes to the UK to set up, where does capital flow through, do we keep all of the sort of clearing activities that we've got here at the moment. I would though like to end on a positive note and say that actually we should be looking at the positive indicators. So who is coming here? Who's setting up new businesses here? Who's deciding to relocate here and actually build? Because that's what we need.
Yeah, I'll just make a quick plug there for the Office for Investments Financial Services unit, which is set up as a joint unit with the regulators, the FCA, the PRA, and the Treasury as well. And part of the offer for that is to speed up authorization for the companies that are deciding to come here.
And I can sort of actually add to that, because we've had discussions with them on a few projects that we're looking at for the long term. And clearly, that is a very, very useful service for institutions that are looking to come into this market for a new business, a new investment, and they can really hold your hand through that, through the process.
I'm so pleased to hear that. I'm pleased you didn't disagree with me. Rhona, I'll come to you next.
I guess the risk to the UK is that it doesn't move quickly enough, right? This is going to happen. Somebody is going to do it. If the UK don't do it, somebody else will. So, I mean, I think it's really key to get on with it. I think early warning signs are when you start to see activity go to other jurisdictions and they start to change and adapt and develop, and we're still looking in our navels going, what should we do next? I think it's really important that structural reform to regulation tax that we're talking about here happens, right? That the report is listened to and action is taken. I think the UK does attract talent, it does attract money, and I think that is a really good reputational piece that we just need to keep going. Gradual erosion will happen, and then suddenly you've got nothing left, and that's really hard to reverse. It's easier to keep things on your shores than it is to get them back once they've gone. So, you know, the UK have got a really broad, deep financial services sector. We're very good at beating ourselves up and not shouting about it, and I think it's really important that we talk positively about it and talk openly about that. Spend the time we need, you know, translate it into action, and really let's move.
Darren, you can either give us a risk or a positive ending note, whichever you prefer.
Am I allowed to do both? Why not? So in terms of risks, I do think we're at real risk of the financial and related professional services continuing in net decline. If you look at our economic modelling over the last 10 years, by the way, and surprised a number of people, we've only grown as an industry at 0.1% over the last 10 years, and that is far less than the economy's grown. So we've been in net decline for an industry that, as Anne highlighted, you know, provides 12% of tax revenue, 11% of economic output, 2.5 million jobs, 2/3 of which are outside London. So that's a real concern. If you look at the modelling going forward, the base case is we grow at 0.5%, which is better than the last decade. However, that's behind the rest of the economy that's going to grow about 1.5% as predicted. So that means we're in continual gradual decline, which is not good for our industry. The great news here, and the upside, and the positive point here is, if we can act with more ambition, speed, and better execution, and if we can deliver on those imperatives we set out in the report, then the prize is huge. As Anne said, it's £53 billion of additional economic output every year over the next decade. And you know, to focus on the positives, that's what we must be focused on. And we must make sure that UK remains the preeminent financial services location in the world, where people, in a world where talent and capital is more mobile than ever, this becomes their first choice. And that is critical for us to continue to grow.
Excellent. Let's come to some audience questions. If anyone, we've got some roving mics in the room, so do put your hand up if anyone from the room would like to ask a question as well. And through the app, we've got a question on which countries get this balance of risk and regulation that we've talked about right, and who we can learn from. Does anyone have any thoughts?
I think this is a really difficult question to answer. I mean, there are lots of countries that we might look to, and, you know, obvious places like Singapore that we might look to emulate, but we have to be realistic about the differences between the UK and each jurisdiction, and that actually this is a problem that you can deal with through legislation, regulation to some extent, but you do need a whole of society approach to it. And the risk culture in a lot of those jurisdictions, the investable domestic income in those jurisdictions is completely different as well. So there's a lot to admire in jurisdictions like Singapore, and dare I say it, Guernsey as well. But I think we have to be realistic about the structural differences between the UK and those places as well.
Yeah, absolutely.
Yeah, can I add to that? Look, I think we have to recognise that international competition is more intense than it's ever been. No longer does everybody default to New York and London. I think if you look at Singapore, Hong Kong, the UAE, and what the US are doing, they're investing heavily in digital and AI infrastructure. They really are. And I think as much as we could argue that their bark is probably worse than their bite, I mean, they've got lots of things in progress, but I'm not sure they're getting things like tokenisation out of the sandbox into production and scaling it up. But I think their PR is much better than us. I think we need to be on the front foot, telling the world we are open and want to lead in tokenised finance. I don't think we do too good a job of that. We're pretty typically British. Despite the fact we are moving in the right direction to lead the world, we need to tell the world we're up for that. And I think other locations do that much better than we do. And I'd argue that the likes of Singapore, Hong Kong, they get the regulators, government industry working together to make sure competition and growth is the primary objective sometimes rather than the secondary one. I think we could probably learn a little bit from how they team and go about doing business and attracting capital and talent to their locations.
Yeah, absolutely.
That's right.
I'll just pause to see if there's any questions from the mics. I don't think so. So back to one of these. Just building on that, we've had quite a specific question on the US where no action relief is the tool deployed to allow businesses to get on with developing new fintech ideas, and comparing that to our use of sandboxes in the UK. If there's no time to lose, which system should we be using?
I probably shouldn't say this as a lawyer, but I think I'm less concerned about the legal mechanism through which you deliver it and more concerned about the supervisory intent that sits behind it. And I don't think it actually matters hugely as long as there is an environment that businesses can test novel ideas in a real world context in a way that promotes innovation and minimises avoidable harm. I'm pretty agnostic as to how you deliver it.
I think that's right. It's about having that sandbox option or something that just enables people to give it a go, right?
Yes. If it creates the outcomes that we want, then it's been successful.
Absolutely.
You're right, but we do need to move forward out of the sandbox at some stage. As I say, we've got to lead. We've got to get into production and scale. And we've got to iterate that. We can't wait for perfect before we get out.
Yeah.
And I think a lot of people say we've got to get out the sandbox, don't they, onto the beach. But, we've got to be moving further faster, I think, because the rest of the world, is catching up.
Yeah, and perhaps that's where it comes back to the political cover that's needed to get these things out of the sandbox and into the world. Well, thank you all so much. I think that's left us with a lot of food for thought, and it's been great sharing the stage with you.
Thank you.
Thank you very much.